What if I told you that one number could control your financial future? That number is your credit score, and it can either open doors to your dream life or slam them shut. But here's the kicker. Most people don't understand it. You might think you know how credit scores work, but are you sure? Today we're diving deep into the truth about credit scores, the things don't want you to know, and more importantly, how you can take control of your score to unlock opportunities, save money, and live the life you deserve. Trust me, this is the video that could change your financial future. So if you don't know your score yet, I suggest you stick around. First, let's start with the basics. What is a credit score, and why does it matter? Your credit score is a 3-digit number that lenders use to assess your financial reliability. It ranges from 300 to 850, so think of it like a report card, but instead of grades in school, it's grading your ability to repay debt. A high score, anything above 700, is great. You're seen as a low-risk borrower. Lenders trust you, and you get access to lower interest rates, which saves you thousands over time. A low score, say below 600, means you're a high-risk borrower, and you'll likely face higher interest rates or even rejection for loans or credit cards. But here's the thing. Your credit score is more than just a number. It's your ticket to better financial opportunities. Whether you're applying for a car loan, a mortgage, or even a job, yes, some employers check your credit, that score could determine whether you get approved or denied. Now I know what you're thinking. Credit scores again? But listen, if you want that sweet car loan at 3% instead of 12%, or a mortgage with a low interest rate, trust me, this number matters more than you think. Now here's the part where it gets interesting. Your score doesn't just appear out of nowhere. It's calculated based on 5 factors. Let's break them down. 1. Payment history, 35%. This is the most important. Did you pay your bills on time? Late payments? Big red flag? 2. Credit utilization, 30%. How much of your available credit are you using? Ideally, you want to use less than 30% of your credit limit. The higher the percentage, the more it hurts your score. 3. Length of credit history, 15%. The longer your credit history, the better. Lenders like to see that you've been managing credit responsibly over time. 4. Types of credit in use, 10%. This refers to the mix of credit accounts you have, credit cards, mortgages, installment loans, etc. Variety here can improve your score. 5. New credit, 10%. Every time you apply for credit, a hard inquiry is made, and that temporarily lowers your score. Too many hard inquiries can be a red flag. Now you might be thinking, okay, I get it, but how can I actually improve this score? Well, I'm glad you asked. Let's start with the most obvious and often overlooked way to improve your score. Pay your bills on time. Late payments can drop your score by as much as 100 points or more. That's huge, and it stays on your credit report for up to 7 years. Now, I get it, life happens. You miss a payment. But here's the thing, you have the power to prevent this. Set up automatic payments or reminders. It's the simplest thing you can do, and it has the biggest impact on your score. So, if you're wondering why your credit score isn't improving, and you've missed a payment or two, well, now you know why. But here's the good news. Once you start paying on time, you'll see results in just a few months. And look, I get it, we all have that one bill that's easy to forget. But do you really want your credit score to look like it's stuck in high school? Let's upgrade that grade. Next up, credit utilization. This one is huge. The more credit you use relative to your limit, the more it hurts your score. So, let's say you have a credit card with a $1,000 limit, and you're using $800. That's an 80% utilization rate, way too high. The magic number to aim for is 30% or less. So, if you have a $1,000 limit, try not to carry more than $300 in balances. But here's a trick. If you can't pay it down quickly, try asking for a credit limit increase. This increases your available credit, and if you keep your spending the same, your utilization will drop. One thing I see people do all the time is close old credit accounts thinking it'll improve their score. But this can actually hurt your credit, especially if you've had that account for years. Why? It impacts your credit history length, which makes up 15% of your score. So, if you're not paying an annual fee, keep those accounts open. In fact, the longer your history, the better your score. I know it's tempting to close a card after paying it off, but trust me, leaving it open could give you the extra boost you need. Now let's talk about credit mix. I know, it sounds like something only credit geeks care about. But having a mix of credit types can actually improve your score. This doesn't mean going out and opening a bunch of new accounts. It means using a variety of credit, like having a credit card, an auto loan, and maybe even a student loan. This shows lenders you can handle different types of debt responsibly. If you don't have any installment loans, like car loans or mortgages, consider diversifying your credit mix, but always do it cautiously. Opening too many accounts at once can hurt your score, so pace yourself. Finally, remember this. Time is your best friend when it comes to credit. The longer you manage credit responsibly, the better your score will become. Building credit is like building muscle. It takes time and consistency. Here's the truth. You won't see instant results. But if you stay disciplined and patient, your score will improve. And when it does, the doors to financial opportunities will open wide. If you're ready to take your financial future into your own hands, then check out my next video on the power of compounding. It's the secret to making your money work for you, and it's a game changer. Trust me, you don't want to miss it. Click here to watch and learn how to make your money grow exponentially. End screen with video link about compounding.